There's no prohibition on trading on both sides of the market, even at the same time. And there are legitimate reasons to do it. You were willing to transact on the orders at the time of entry. That doesn't mean you can't change your mind. Of course you can, but you can't have a pre-existing intention to cancel. That's not a bona fide order. You're just basically trying to affect some other purpose, like you're trying to get an execution at a better price, and you don't have an intention to execute at those other prices on the other side of the market, and that's spoofing.
How did the CFTC determine that Brett Falloon and Flatiron Futures, LLC, had engaged in spoofing?
It does look like we have some pretty striking trading patterns here. You have, canceled orders that were large and away from the market, and they were canceled shortly after he got fills on the other side. The canceled orders were a majority of the visible market depth and outnumbered his fill orders by a ratio of 5-1. So that's a pretty classic, pretty typical spoofing pattern. I don't see a lot of gray area with those patterns. Large orders on one side of the market away that are getting canceled shortly after orders closer to the inside market are getting filled. That doesn't sound like somebody who's trying to hedge his exposure or looking for price discovery or looking to trade a spread.
Did the spoofing affect other market participants?
That's a really complicated question, and one that, expert witnesses would typically be asked to look at. It's always difficult to quantify price impact, market integrity, especially here where we don't know the size of Falloon's trades. We know the quantity of his trades, and it looks like a lot. It's 400 spoofing events over 8 months, including over 1,900 spoof orders in the aggregate. So I think that's a high number over an 8-month period. And the order does say that his spoof orders were a large percentage of the orders resting at the top price levels at the time the orders were placed. I have to believe there was some price impact. I wouldn't assume that the price impact was massive here, given just how liquid these markets are. And, he was not fined millions of dollars here, so I suspect that he had good arguments that the market impact was not huge.
How do these spoofing charges compare to Falloon's past violation at the CBOT?
It looks to be less serious violations with a less serious penalty. But it absolutely matters. It does matter when it's a repeat violation. The CFTC, like other regulators, considers the relevant disciplinary history of the respondent anytime it negotiates a settlement, and that includes a settlement from another regulator like CBOT. And the CFTC actually says this in its enforcement manual, so it likely had an impact. It was not discussed in the order, so it's very hard to quantify it, but it's relevant disciplinary history.
What risk management practices are usually in place to stop spoofing?
It's hard to know what this firm did. It's a small firm. It was not a registered firm. It was not registered with the CFTC. It's not clear to what extent this firm had a compliance function. I don't see it discussed in the order, much less an effective one. But I can tell you that it should, whether it's a small firm, a medium-sized firm, or a large firm, it should. It doesn't end there. The broker-dealers and the commodity brokers have sophisticated ways to monitor spoofing. Those are the first lines of defense. And most executing brokers have automated surveillance systems that are designed to detect spoofing and other kinds of market manipulations, but spoofing's been on that menu for a long time.
What lessons should traders, brokers, and compliance professionals take from this enforcement action?
The CFTC is watching. The SEC is watching. The SROs are watching. That's a lot of people watching, and compliance needs to be watching. Again, I don't know if compliance was watching in this particular instance, but firms need to have surveillance to detect patterns of spoofing activity, and they need to take action before it gets to the CFTC or some other regulator. So it takes some real investment, and compliance has to be a priority. Even at small firms like this, these investigations take a heavy toll on firms. They are costly in time and expense, whether you win or lose. That's true. And they are public. So you do real harm to your reputation anytime you take on a big regulator like the SEC or the CFTC.